All right, everyone, welcome back. A brief break, and now we're going to roll over to Brandon Hall, who is my personal CPA and our uh, our advisor on really anything tax on business and personal. So, Brandon, I'll make you a host, and then we'll go from there.
Awesome.
There he is. How's it going, sir?
Good. Thank you very much for the invite. Looks like you got a good crowd of folks here.
Yeah, they've been engaged the whole way through. Great questions. We just talked about deferred sales trust, which I know some accountants don't always like, but some do. That's a new office. Have you moved?
Yeah. We moved July of 2020. So
Where to?
Raleigh, North Carolina, just kind of
Oh,
up
nice.
the street from our old house.
Yeah,
Once
think
you have a kid or two, the
I
houses
think
get small real quick.
I think Durham's gonna be in a big spot here in the next few years to blow up.
Yeah.
So
Yeah.
it's great.
Yeah.
Cool. Well, hey, tell you what. So audience is excited. We need someone like you on to kind of keep us sane and aligned to what's happening and with the Biden administration and the tax proposals, but also generally, I think, talk about some of the key strategies that you're seeing in the market and with your clients, and go from there. So, what do you say?
30 minutes.
Yeah, 25 or so, and then questions. Yeah.
Okay. Sounds good. Cool.
Let's do it.
I'm going to share my screen, and then how are we doing questions? People just throw in the chat?
Yeah, so because you're the host, the questions will be in the chat.
Cool. All right. Thank you very much.
All right.
Floor is mine.
Yep, go ahead.
All right. Thanks. All right, guys. My name is Brandon Hall. I am managing partner. I'm a CPA, and I'm the managing partner at the Real Estate CPA. We are a team of 23 people at this point, and we're a remote firm. So my 23 teammates, we all work out of our homes. I actually like to joke that we have 23 offices. Makes it sound really, really big, you know. but we all work out of our home across the United States. I think we're like physically located in like 12 or so states at this point, but we have clients in every single state. We only work with real estate investors, so you have to be involved in some level of real estate in order to be one of our clients. And we have about 700 clients across the United States. So we've been at this since 2015. That's when I started the firm, and it's been a really interesting ride. I think that we're pretty darn good at what we do, and what we do is tax planning for our clients. So we'll help look at somebody's situation and figure out, how can we implement various tax strategies to reduce or mitigate any sort of income tax that you're going to be facing. We also provide accounting services and a lot of like education workshops, that type of thing for our clients as well. So kind of across the board.
What about your podcast?
We do have a podcast, the Real Estate CPA podcast. If you actually go to the realestatecpa.com, sorry, let me slow down, therealestatecpa.com, you'll see all of our educational material, including the podcast. But yeah, we have about 50,000 downloads a month. So it's a pretty popular podcast. We talk about everything, and a lot of the stuff that I'm going to talk about in this presentation is also in detail on the podcast there. And then we do have a Facebook group that I'm going to mention throughout this. It's a free Facebook group. It's called Tax Smart Real Estate Investors. I'll chat it up a little bit later, a link to it. But if you have any questions that we don't get to during this presentation, jump into that Facebook group and ask there. So we have about 3,300 real estate investors in that group that are all asking tax questions all day long. So.
Cool.
All right. So I'm going to share my screen. What we're going to talk about today are the top 3 tax strategies that we are often advising on. In the presentation mode here. How's that look, Tom? Is that good?
That's great. Yeah. All
right, cool. All right. So before we really start with anything, we have to talk about just the tax benefits of investing in real estate in general. Because if you don't understand that, then the rest of this presentation is not going to make any sense. So when I buy a piece of property, a piece of rental property, I'm going to receive income from that rental property, right? The tenant's going to pay me rent. I'm going to have operating expenses like property management fees, insurance, property taxes, repairs, maintenance, all that type of stuff. I'm going to have a mortgage payment. It's going to have interest and principal. And then I'm going to be left with some chunk of change at the end of the year. So I'm going to have my gross rents minus my operating expenses, minus my mortgage payments, and I'm going to be left with a chunk of change at the end of the year. And are you approving people while we're?
That will be you.
Okay. You need me to do that? Cool. I'll do that. There we go. Middle. Okay. So when I'm left with this chunk of change, right? Let's say I buy a $300,000 single family home. I have $24,000 of gross rents, and I have $20,000 of operating expenses and mortgage payments. All that combined is about $20,000. So I'm left with $4,000 of cash flow on a $300,000 single family home purchase. But what I do is I have to depreciate that $300,000 acquisition over a period of time. Now I depreciate because, sorry, I'm trying to like add people and speak at the same time. I'm just gonna speak and add people every 5 minutes or something, so it's not distracting. My bad. So when I invest in this real estate, I get the rental income, I have the operating expenses, and I have at the end of the day the net cash flow that actually hits my pocket. But in this example, if I have 24K of rental income and I have $20,000 of expenses or payments that I've made, then I've got $4,000 in cash flow, but I'm probably telling the IRS that I lost money. Now, how is that possible? It's because of depreciation. Depreciation is an expense that you get to claim every single year on your tax returns simply because you acquired the asset. And depreciation is meant to track the deterioration of your real estate over time. When we talk about depreciation, a lot of people go, well, real estate appreciates, so why would there be depreciation? The value of real estate appreciates, you're correct. But depreciation is meant to track the deterioration of your components over time. Just because the value of the building is going to increase over time doesn't mean that the roof's not going to fall apart, right? So the roof's going to fall apart. The windows are going to fall apart. The appliances, the carpeting, everything's going to fall apart slowly over time. And depreciation is essentially a little credit that you get every single year that tracks that falling apart. So in this example, if I have a $300,000 home, let's say that I allocate $30,000 to land. So whenever I acquire real estate, I have to allocate that purchase price between the building and its components and land, because land cannot be depreciated. Land does not deteriorate with time, right? The components of the building deteriorate with time. That's what we're tracking. So maybe I allocate $270,000 to the building and all of its components, and I allocate $30,000 to my land. So I'm depreciating the $270,000, and I'm depreciating it over 27 and a half years. Why 27 and a half years? I have no idea. When they wrote the rules, that's what the number was. So they probably did all these studies to determine 27 and a half years is the perfect number. And that's what we use. So 27 and a half years for rental real estate. So $270,000 divided by 27 and a half years, about $9,500 a year. So in my example, where I earn $24,000 of rental income and I have $20,000 of payments and expenses, I still get to tell the IRS that I lost money because I'm also tacking on top of all of that a $9,500 expense for depreciation. So even though $4,000 hit my pocket, I'm probably telling the IRS that I lost $5,000 or $6,000. That's kind of how this works. So the beautiful thing about real estate is I can earn that cash flow without paying tax on it. I earn the cash flow. I have depreciation that shelters the cash flow. So the $4,000 that hits my pocket is tax-free to me today. If I can replicate that 10 times, now I've got $40,000 hitting my pocket every year, and that's tax-free to me today. If I can replicate it another 10 times, now I've got $400,000 of cash flow hitting my pocket tax-free to me today. You do have depreciation recapture tax, so you do have to pay this tax-free or this tax deferment back at some point. We're not going to have time to jump into that. But for today's purposes, just understand that depreciation shelters my cash flow. And from a time value of money perspective, that's a beautiful thing. I want to be able to shelter my cash flow today.
Let me ask one quick question. I know oil is one's a very attractive tax hedge too. Is there any, I mean, generally speaking, is there any better tax shelter than real estate?
Not that I'm aware of.
Yeah.
There are solar syndicates out there, and I'm not 1000% sure how they work. But I mean, yeah, we have seen a lot of alternative investments, and it seems that real estate is the best one. Not only from a tax perspective, but a lot of these other investments, you have to invest $1 to get 70 cents back, right? Like you can invest in oil and gas right now. You invest $1, you get 70 cents back, and then you save, 20 cents as a result in taxes. So it's kind of like one of those things where it's not that beneficial. You're still taking a pretty big risk, but real estate, you can invest the $1, get $1 back in losses,
Yep.
and get 40 cents in tax savings, and it's going to grow over time. So,
Yep.
so no, my answer is real estate, and I'm extremely bullish on real estate.
Yep.
But anyway, all right. So now that we understand the general tax benefits of real estate, we got to talk about the passive activity rules, and then we're going to get into our top 3 tax savings that you need to be aware of going into the end of this year and next year. So the passive activity rules, that $4,000 of net income, when I offset that with my $9,500 of depreciation, and I end up with about $5,000 of losses. Right. These are tax losses, not actual losses, because depreciation is a phantom expense that I get to claim every single year. I don't have to pay for it every single year. I paid for it all up front when I bought the asset. It doesn't matter if I paid cash. Doesn't matter if I did 100% financing. Doesn't matter if I did 70% financing. Doesn't matter. I get $270K of building basis that I get to write off over 27 and a half years. Gives me $9,500 or so in depreciation every single year. Maybe a little bit more than that, but every single year. Now, the question is, my depreciation, when that produces a tax loss, right? Not an operating loss, because in our example, I've got $4,000 of actual income that's hit my pocket. So that's operating income. But I told the IRS that I lost money thanks to depreciation. So I told the IRS that I had a tax loss. When I have a tax loss, can I use the tax loss? That is the question. And to answer that question, you have to understand the passive activity rules. And this is where we do most of our consulting at our CPA firm, is helping clients understand the application of the passive activity rules and how they can use the passive activity rules to their benefit. The passive activity rules say that all rental real estate is passive. All rental real estate is passive unless you qualify as a real estate professional. They also say that any trade or business that you don't materially participate in is passive. So there's 2 types of passive activities: all rental real estate unless you qualify as a real estate professional, and 2, any trade or business in which you do not materially participate. That's passive. Everything else is non-passive. So in effect, we have 2 buckets of income. We have passive income and we have non-passive income. The funny thing is that literally every taxpayer is subject to these rules, whether or not they realize it. So when people get into real estate, they start learning about the passive activity rules, and they start recognizing, oh, my rental income's passive, my other income's non-passive. They don't realize that they've always been subject to these rules. Anybody that earns $1 is subject to the passive activity rules, right? And the passive activity rules say that there's 2 buckets of income. There's passive income, there's non-passive income. The problem is that if I have passive losses, they can only offset passive income. If there is no passive income, then the losses are carried forward. They're suspended and they're carried forward until I can use them at some future point. They're carried forward indefinitely. You don't lose them. They're just carried forward until I can use them at some future point. So passive income, all my rental real estate, unless I qualify as a real estate professional. Any trade or business in which I don't materially participate in. What does that mean? Well, let's say that I went and put $100,000 into my local hair salon. They were expanding into a new shop. Now, I'm just the capital guy. I'm not making any decisions. I'm not voting. I'm not part of the day-to-day operations. It's a passive activity for me. So if they pass $10,000 back to me, maybe I'm earning 10% on my money. They give me $10,000 in profits. That's passive income. That's in my passive bucket. And my rental losses, because they're passive losses, they can offset the passive income from the hair salon. So this is kind of how you use the passive activity rules to net everything out against each other. But the important thing to know is that if I'm not really participating, it's a passive activity. And if I am participating, it's a non-passive activity. So what are my non-passive activities? My W-2 income is non-passive. Business income, where I am participating on an ongoing basis, like me running my CPA firm, that's non-passive. Gain from my stock sales. If you sell Tesla or Apple or GameStop, that's all non-passive as well. Interest income, dividend income is all non-passive. So all of that income is in the non-passive bucket. My rental losses are in the passive bucket. And since my rental losses are in the passive bucket, I cannot offset my W-2 income with my rental losses. I cannot offset my business income with my rental losses. I cannot offset the gain on the sale of stock with my rental losses because that's all non-passive. It's in my non-passive bucket. So my rentals are stuck in that passive bucket unless I qualify as a real estate professional. So that's we're going to skip this slide and just jump right into it. So real estate professional status. Qualifying as a real estate professional allows you to overcome the presumption that your rentals are by default a passive activity. If you also materially participate in your rental activities, you will have successfully moved your rental activities out of the passive bucket and into the non-passive bucket. The significance of doing this is that now, once I make that move, once my rentals are in the non-passive bucket, my rental losses can offset my W-2 income, my business income, my gain on stock sale income, my interest and my dividend income, and any other type of income that's non-passive. So that is tax optimization at that point. I'm fully optimized because now I can create rental losses and they can directly offset all of my other income sources. That is ideal. That's perfect world. To get there, in rental real estate, you have to qualify as a real estate professional, step one. Step two, you have to materially participate in your rental activities. Now, how do you qualify as a real estate professional? You have to spend 750 hours in real property trades or businesses, and you have to spend more time in those real property trades or businesses than you do anywhere else. Well, that latter rule, more time in those real property trades or businesses than you do anywhere else, that kicks everyone out that has a full-time job. You can't work a 2,000-hour full-time job and think that the IRS and the tax court is going to buy that you also spend an additional 2,001 hours working on your rental real estate. It's just not going to work, right? So more time in rental real estate or more time in your real property trades or businesses than anywhere else. Now, why did I just catch myself? And I didn't just say rental real estate. I said real property trades or businesses because there's 11 real property trades or businesses. Rental real estate is one of the 11. Other real property trades or businesses are like development, redevelopment, leasing activities, property management activities, rental operation activities. So there's a lot of different real property trades or businesses that you could be running, not just being a landlord. But the important thing with real estate professional status to know is that it's 750 hours in a real property trade or business or businesses. You can do multiple real property trades or businesses. Just across all of those real property trades or businesses, if you work 750 hours and you spend more time in those real property trades or businesses, then you will be a real estate professional. So you could be a full-time real estate agent. You could spend 1,800 hours a year being a real estate agent. You would be a real estate professional, but you might not be able to justify material participation in your rental activities. Because remember, that was step two. Step one is to qualify as a real estate professional. Step two is to materially participate specifically in your rental activities. There are 7 tests to material participation. The three that we see most often, or I guess the 2 that we see most often. 1, you work 100 hours and more than anyone else. 2, you work 500 hours in the activity. So not only do you have to qualify as a real estate professional, you have to spend 750 personal service hours in real property trades or businesses and more time in those real property trades or businesses than anywhere else. That's step 1. Step 2, you have to materially participate in your rental real estate activities by showing that you spent 500 hours working in your rental real estate activities or 100 hours and more than anyone else. And more than anyone else just means if I've got a property manager, I have to outwork them. That's what that means. I have to spend 100 hours and I have to outwork everybody else. Or I can spend 500 hours. That's kind of a safe harbor there. Now, if I work 750 hours as a landlord and that's all I do, then I'm going to hit step 1 and 2 at the same time. Why? Because I'm going to hit this first bullet point, spend more than 750 personal service hours in a real property trader business. Well, being a landlord is a real property trader business. So I hit that. Let's say that's all I do. So I spend more time being a landlord than I do anything else. So I hit that. So I'm a real estate professional. And because I hit 750 service hours as a landlord, then I'm also automatically going to have hit 500 hours of material participation in my rental business. So I'll kill two birds with one stone there. There are hours that count and don't count for the purposes of time. I would suggest going into our Facebook group, Tax Smart Real Estate Investors, on Facebook, and ask there for some clarification. Or we have an entire guide on this on our website at realestateCPA.com.
Hey, so let me
Real
ask you
estate
a question
professionals.
quick. So if, let's say, someone is married, right, who has a W-2, and then the other person is not, is married too, but if they're one person's married, W-2, and the other person is a qualified real estate professional, does that impact the total tax income at the end of the year, or is that a separate thing?
Yes. So that is the significance of it. So if you are a real estate professional, then when you file your tax return in total will be a real estate professional. So what that means is any rental activity that we acquire, we can group in to this real estate professional activity, assuming that we materially participate, and we can make it non-passive. So where this strategy works is it works a lot, but where it really works is where you have one high income spouse, somebody that's earning several hundreds of thousands of dollars, and you have another spouse that's either doing a part-time job or they're staying at home, whatever the reason is. That spouse that is not the high income spouse, they go and qualify as the real estate professional, because the high income spouse can't qualify. They got to spend more time in real estate than they do anywhere else. They got a full-time job. They're not going to qualify. So what they do is they get the spouse that isn't the high income spouse. They go qualify as a real estate professional. And now their rental activities are non-passive, and they can offset the W-2, the high income W-2 of the other spouse. Yep. So you can certainly do that. One spouse has to qualify, meet those hour thresholds completely on their own. But it's definitely something that you can do. And remember, the whole purpose of doing this is to move my rentals out of the passive bucket and into that non-passive bucket. Because when I can do that, I can use those rental losses to offset my W-2 income. And then you start talking about cost segregation studies and bonus depreciation. You can buy a $300,000 single family home and you can get a $50,000 first year bonus depreciation deduction. Well, if you've got a high income spouse that's earning $500,000, that $50,000 just reduces that, and it saves you probably $20K or so in taxes. So then you start replicating that. But you have to get the real estate professional stuff down. You have to understand the passive activity rules. You got to understand how those two buckets of income work. And you got to understand what it takes to move the income out of the passive bucket into the non-passive bucket. And if one of the spouses qualifies as a real estate professional, both spouses, when they file the tax return, will qualify.
Yep. And by the way, we have about 7 minutes left. So if you all have questions in the meantime, do put them in the chat. Brandon will see them.
Yeah. All right. Short-term rentals. Short-term rentals are special. So if the average period of customer use is 7 days or less, I know this is less than 7 days, but it should be 7 days or less. The average period of customer use is 7 days or less. That means however many tenants I have, take my total rental days divided by the total number of tenants that I have. If it's 7 days or less, then I do not have a rental activity under the passive activity rules. Now, if we go back to the first slide, the passive activity rules say all rental activities are passive unless you qualify as a real estate professional. That's one. Two, any trade or business which you don't materially participate in is passive. Well, if we just look at the first bullet point, all rental activities are passive unless you qualify as a real estate professional. And now if we look at this slide and we see, if it's 7 day or less on average rental, then it's not a rental activity. Then what that means is I don't have to be a real estate professional in order to claim the losses from my short-term rentals. All I have to do is materially participate in the short-term rental activity. Now, why is this significant? Because real estate professional status, remember, that was step one, and step two was material participation. But here we get to get rid of step one. We don't have to worry about real estate professional status. And remember, one of the rules with real estate professional status was you have to spend more time in real estate than you do anywhere else. Well, if we're getting rid of that, then I can be a high income W-2 earner. I can be a business owner. I can buy short-term rentals and I can still make the short-term rentals non-passive. So I can move the short-term rentals out of the passive bucket and into the non-passive bucket, even though I'm working full-time, as long as I materially participate in the short-term rentals. Same material participation rules apply to short-term rentals as they do to long-term rentals. So 500-hour test, 100 hours, and more than anyone else, that stuff is still going to apply. So how do you meet those tests? Well, 100 hours more than anyone else is the big one that most of our clients go for with short-term rentals. So first strategy is you can't hire a property manager, because if you do hire a property manager, most likely the property manager is going to outwork you, which is going to kill strategy number 1 and 2 here. And I'm not going to hit number 1 because that's going to take some time to explain. But 100 hours more than anyone else, if the property manager outworks you, then you lose. And now you have to hit 500 hours. And that's going to be tough to do on a short-term rental. But once you materially participate, like I just bought a beach home, for example. So let's say that I bought it for $900,000. I materially participate because I self-manage it. I have a number of tenants coming in. They're all 7-day or less average turnarounds or turns or stays, reservations, whatever you want to call them. So I'm still new to that world. But then I do a cost segregation study. Well, cost segregation study on a beach home might get me $180,000 of bonus depreciation. Well, if I materially participate in that beach home and managing that beach home, then I can take the $180,000 bonus depreciation and I can offset my business income. And I don't have to be a real estate professional. I don't have to worry about it. I just have to materially participate. And that $180,000 of bonus depreciation might yield $70,000 in tax savings. Really, really powerful stuff.
Yep. And again, this is exactly why I tell everyone here that it's great to focus on top line growth, but you got to think about taxes as an expense, as another massive opportunity.
I'm going to hit this one in 30 seconds, but this is so all that stuff is cool, but this is the number one thing that real estate investors miss on a consistent basis, and it's partial asset dispositions. So when I go in, when I buy a piece of real estate, I'm buying all of the components that make up that piece of real estate. I'm buying the roof, I'm buying the windows, I'm buying the carpet, I'm buying the appliance, I'm buying everything in that real estate. When I go and replace those components, I'm supposed to write off the value associated with the component that I replaced. And that logically makes sense because that component is no longer in existence. So I should be able to write off the value associated with it. If I don't write off the value associated with the component that I've replaced, that I've ripped out of my property, now then technically I'm depreciating 2 of the same components. Example, I buy a property, comes with a roof, obviously, hopefully comes with a roof. I replace the roof. Well, if I don't write off the cost of the old roof, whenever I replace it with the new roof, now I'm technically depreciating 2 roofs. So what we want to do is we want to write off the costs of the assets that we're ripping out. You got to work with your CPA on this, but it's called a partial asset disposition. Tom, I'll shoot over these slides so that you can distribute them and you guys can read through that.
Awesome. Yeah, this is great. I mean, the content level that you bring versus other CPAs that I've worked with is just, it's night and day. So again, this is on replay, this whole conference. So we're going to send out that along with the links as to where to get a hold of Brandon or Brandon's team, and go from there. So Brandon, as always, it's been great.
I appreciate it, Tom. And I'm going to, if you don't mind, can I shoot out a link to that Facebook group?
Yeah, 100%.
In the chat? All right, cool. So I'll do that.
Or send it to me, and then I'll put in all the stuff.
Cool. Yeah, I can do that too.
Thank you.
All right.